product market fit for restaking and why it is going to boom as an industry beyond what crypto has done so far. A little bit of background: I run DeFi operations and tokenomics for Alpha Growth. My background's in economic philosophy, and I focused the last 4 or 5 years on decentralized business and on monetization. We're really good as a space at building science fair projects, building new ways to do new things, but we struggle at, obviously, getting real business integrated, getting real revenue, growing real sales. And so we found a pretty cool way to do that. We've got some projects that are working on it. Today I'll go over restaking, a brief overview, talk about insurance, show why they're a perfect fit together as a new business narrative, and then go over a couple examples with medical insurance as well as DeFi insurance. So what is restaking? You guys have all heard the term by now. Plenty of companies raise a whole bunch of money on it as a narrative. But walk through the history. We start off with staking. You know, Ethereum eventually makes a switch. You stake Ethereum, that's how you provide security to the network. But now you're giving up the opportunity costs of liquidity and being able to participate in DeFi. So Lido and Rocket Pool and a bunch of other service providers create LSTs, or liquid staking tokens. So now, yes, you're securing the network, but you also get to take action in DeFi. But then the next step was security hypothecation. This is what Eigenlayer figured out. And this is, you take that new liquid staking token and you restake it. And now you're providing security in a second place at the same time. And they did this in theory. You know, it's boomed over the last 2-3 years. I think the story is 3 years ago. Sriram, we just saw here a little bit ago, was struggling to get in here. And now, obviously, Eigenlayer is one of the biggest names in Ethereum. But he made this possible. And now it's our job to figure out how to make this work for the business. And so fundamentally, the benefit of this hypothecated security is access to capital. Keep that in mind, we're going to come back to it. Access to capital. So, who are the clients of restaking right now? You may have heard the term AVS, which is an actively validated service. I helped design King Protocol, if you've heard of them, working with EtherFi and a whole bunch of the primary LRT providers to be able to wrap all of these different rewards from all of these different AVSs who come in and do rent security. But one of the FUD or the arguments around this is like, oh, so this is just going to be new tokens, or with maybe, you know, low flow, high FDV, the things that we've been burned by before, paying out in their native token to rent security, not do anything with it. Like, how do you get real money? How do you get real yields? We're talking about RealFi, right? Where does it become substantial? And right now, this is a hole that is not fixed. Switching for a bit. What is insurance? Insurance, it's kind of like a shared savings account. But with a shared savings account, you'd start at zero and work your way up. With insurance, you need money right away, right? So it's like a shared savings account that starts high. This brings us back to access to capital. Insurance is kind of like an open loan, a line of credit, if you will, that becomes a shared savings account once it's paid off. Insurance is a different form of access to capital. And it's masked as private sector, but I've got some issues with that. Again, economic philosophy, if you go into monetary theory or economics, economics fundamentally is how to distribute scarce resources. And the private sector creates resources. They're finite, but they're not fixed. So private sector creates resources. Hey, insurance is private sector, right? Isn't that great? But public sector will then distribute resources more effectively. Everything's private sector, you get crony capitalism, more resources distributed incredibly inefficiently. If you go full public sector, you get communism, minimal resources, distributed very equitably, we're all equally poor. We need something better, and by trying to make insurance companies more fair, the public sector has forced everybody to buy them and created a captive audience. You all have insurance, I have insurance, a bunch of different types of insurance. We have to live our daily lives. And the processes that bureaucracy or public sector have used to make us purchase this, the profit caps that insurance companies have actually force them to operate purposefully and efficiently, just based on the game theory, in order to make more profit. And like, they're all C Corps. Literally their entire obligation is to maximize profits. Like, and only thinking 1 year ahead at a time. So we have force, inefficiency, and ineffectiveness, and it's destroying insurance, and we have a new opportunity. So I walked through who are the clients for restaking providers. There are a couple, but right now it's lacking. It's not enough to justify the current valuations, let alone increase. We need to do better. But who are the providers for insurance? United, Cigna, Aetna, that's health insurance. How about big banks? Yeah, not everybody's favorite people. Not everybody who's aligned to help the people who are, being taken care of. Deny deposit, depose. So, let's start with our first example. And so we'll get into medical insurance and DeFi insurance. Could we decentralize health insurance? Could we match the access to capital available through restaking to the access of capital required by these insurance companies? We're going to look a little bit at health insurance. Health insurance companies also have insurance. You guys know insurance companies have insurance? That is called reinsurance. It goes levels and levels and levels. Typically, a health insurance company will have two types of health insurance, at least. Stop loss insurance, to make sure that they don't assume all of the risk in case somebody costs $250 billion or something. The two types are aggregate. This would be, in your opinion, for your personal health insurance, you're like max out of pocket. The second would be spec, or specific stop loss. This would be like your deductible. This would be the max allocation for a single person. And when you're paying your healthcare premium, the cost of these that go to your insurance provider, if you've got Cigna or United, these costs are baked into your premium because they're paying their reinsurance providers for both of these things. However, looking over these models, we believe, and we do in fact have, a product where we can get rid of the spec insurance, charge less for the ag insurance, and save a whole bunch of money for operations through using Eigenlayer and its associated projects instead for a line of credit. Here on the screen I've got the max ag insurance. Think of this as a healthcare company that's got, say, 100,000 members on it. And so maybe we have a stop loss insurance that anything higher than $60 million is going to be covered by a reinsurance provider. And right now that's still TradFi. So we've got a contract with State Farm or one of these other big banks. We don't have a spec insurance here, and we do know we've got the ARR, the returning revenue of healthcare premiums. And so if we have a max expense of like 60 million, and we know we're gonna make, I don't know, 100 million, I'll make the numbers 80 and 120 million, it works better for a calendar. So we can only spend $80 million max. We know we're gonna make $120 million. We can for sure say at the end of 1 year, we've made at least $40 million in profit. Maybe operational overhead is 20 million of that, so then it would only be 20 million profit. But you know that there is a minimum profit that can be made. The only risk now is if you hit this aggregate early. If a third of your patients end up having heart attacks in the first couple months, and you have to dip into this line of credit that's available early on. So, what we need now is a potential line of credit to protect us from early claims, and we can guarantee profit at the end of the year. So what is a RELOC? You guys have heard of HELOC, I assume. A home equity line of credit? Well, we're saying a restaking line of credit. This is helping our insurance products. It's not insurance directly in and of itself, but it is providing the access to capital required for a normal insurance company to be able to underwrite the plans that they're offering. If we then strike a deal with a reinsurance, with a LRT provider for a line of credit, we can underwrite it with legal contracts, talking about a mix of legal and smart contracts now, and we can predefine when can slashings occur, when can you pull off drawdowns where you take some of the capital originally, and you can lock up the participants, whitelist even the participants, for who's allowed to earn this yield. And maybe we say, hey, we can give you guys 12% APR for 1 year. You just have to keep your funds locked over a year. If expenses are lower, maybe it even goes higher than that. But now we can guarantee real yield, and the profits that currently go to insurance companies and the current providers of insurance can go to you. If you're staking Ethereum and your operator is opting in to things that might be slashed, but are gonna end with a higher net yield than the people who are just, right now a lot of restaking is kind of a meme. Not even all of slashing is available. So congrats, you operated a node properly. Like, what we're talking about is real business. The specialty isn't the node operation. The specialty is the contract and the services and the capital that's being allocated. Fundamentally, this turns into an entire new market type. Every type of insurance can exist. Every type of customer can be serviced. Any LRT, any provider, any wallet operator for these LRTs can be as risk on as they're willing to underwrite for their users. We get a whole new Moody's. This is real business. TradFi becomes an AVS. AVS, the clients of LRT providers. Oh, what kind of yield are we gonna get? Well, maybe points. We get our ETH and then we can get some governance tokens. Talking about getting paid in cold hard cash. I'm saying if we paid 10% per year for this insurance company at a guaranteed profit, that I'd rather give that 10% to people staking ETH, working more transparently, working more efficiently, getting rid of the company bloat, getting rid of the 6-month payment times, and saving a whole bunch of money while running business right. This is not just the right time for this technically, now that the pieces are in place for this to work. This is the right time for it socially, as everyone is acutely aware of how insurance companies are running and how terrible service is. I'm not going to get too far into products right now, but if any of this stuff interests you guys, I'd love to talk to people afterwards. There are real projects working on these real products I'm talking about. And that's good for health insurance. What about DeFi? Is DeFi doomed? Is it just going to be governance tokens on governance tokens, narrative after narrative, monkey pictures? What's OEV, all this new stuff coming out? DeFi has not brought in the TradFi money. We're waiting for it. We're wanting it. Everybody knows we need it, but I'm sure we've seen a bunch of presentations here this trip about like how we can do trading a little bit better and what is going to say that, hey, we're going to bring in hedge funds to start managing their funds on chain. Where's that? What is stopping it? And at Alpha Growth, basically what we have come to terms with, especially dealing with family offices, dealing with sometimes even nation state players of what it would take to have them start using, say, Compound, which we work with. Start using Compound instead of Bank of America. And what it boils down to is they need to get rid of contract risk, get rid of variable rate risk, and get rid of regulatory risk. Well, regardless of your political opinion, I think we can all agree the current presidential regime now is better on the regulatory risk side. Depending on the country you live in, there are some better opportunities than others, but we're all working on it. There's lobbying going on. We need to, Lord knows, get better laws and education to people who don't really know what emails are up in Congress, but we're working on the regulatory risk side. We've got protocols built that let you switch variable rate for fixed rate. Why do people buy bonds from Michael Saylor at a 50% premium on Bitcoin? It's because their funds can only purchase and operate in bonds. So they take what risks and rewards they can with what they're legally allowed to. And many of these funds and firms are not allowed to dabble in variable rate risk. We cannot ourselves fix the variable rate risk, so protocols that can enable this kind of OTC swap reduce that risk. But how do you fix contract risk? And I'm sure you guys are getting to it. You can insure it. What can you insure? You can insure anything. Protocol, TVL. What if all of the TVL on Compound was insured? What if just I launch a meme coin, but I insure the insurance of that liquidity? I mean, it might be difficult to get EtherFi to underwrite it or to get an operator to buy in, but any of this stuff is now possible. Hopefully you guys have seen MetaMask showcase their new debit cards. Well, debit cards have to be KYC'd. If you're KYC'd, you can't really be Sybilable. So what if we launch our own FDIC account and it's got higher insurance per user and higher yield than a traditional checking account? without even needing the government to back it. Bridges, we've seen bridge hacks. Heck, you can probably even get operators to underwrite bridge hypothecation, making bridges profitable to the ecosystems that attract TVL. Bad debt, we've all seen DeFi protocols that weren't as safe as we were led to believe. Stability pool pegs, SMOs. We can insure anything. This is an entirely new market. So, that is it for the time I've got with a teaser. I would love if anybody has any questions or would like to talk to me more. Yes, sir. Yes. He asked, what is the next biggest asset or industry that is going to be insured? And I believe it is going to start with medical insurance. I think that will happen maybe in tandem with DeFi, but I think we're closer to medical insurance being possible and existing now than many of you guys realize. And that will help capture the narrative to spread onto DeFi as these pay rails get built in. I mean, we need entirely new service providers for this to exist. We need actuaries to come in. We need every LRT provider to become an insurance company and operators to figure out whose Moody's system, if you will, they'll use to determine what to underwrite and what not to. This is work I've been doing for the last 5-6 months, so we got a little bit of a head start, but it's a narrative that is inevitable and that we very, very much need on Ethereum. If you guys have any other questions, I apparently got 2 minutes, but other than that, I'm happy to talk off stage. Other than that, I'd love to hear what you guys would like insurance in and who you'd like to buy.